QYLD ETF, a deep dive into a high-yield covered call strategy. The Global X Nasdaq 100 Covered Call ETF, QYLD, has attracted significant attention among income-oriented investors for its high dividend yield and unique covered call strategy. Yet, its intricacies and limitations often remain misunderstood. This article delves deep into QYLD, analyzing its mechanics, advantages, disadvantages, and suitability for different investor profiles. Understanding the covered call strategy. QYLD is not a typical equity ETF that tracks the Nasdaq 100 index passively. Instead, it employs a covered call strategy, also known as the buy-right approach. Here's how it works. Underlying holdings. QYLD tracks the Nasdaq 100 index by holding the 100 largest non-financial companies listed on the Nasdaq exchange. Selling call options. Simultaneously, QYLD sells out-of-the-money call options on the Nasdaq 100 index. These options grant the buyer the right, but not the obligation, to purchase the index at a predetermined strike price, by a specific date, expiration. Dual income streams. QYLD earns income from dividends. The underlying Nasdaq 100 companies distribute dividends, which become part of QYLD's income. Option premiums. By selling call options, QYLD receives upfront premiums, regardless of whether the options are exercised or expire worthless. Benefits of QYLD. 1. High dividend yield. QYLD's covered call strategy prioritizes income generation. As of January 24, 2024, it boasts a 11.34% annual dividend yield, significantly higher than the average equity ETF. This makes it appealing to investors seeking consistent income streams. 2. Reduced volatility. Selling call options limits potential capital appreciation, but also caps potential losses. This dampens QYLD's price fluctuations compared to the underlying Nasdaq 100 index, offering a smoother ride for income-focused investors. 3. Lower expense ratio. QYLD's expense ratio of 0.63% is relatively low compared to other actively managed ETFs, further bolstering its appeal for cost-conscious investors. Disadvantages of QYLD. 1. Limited capital appreciation. Selling covered calls sacrifices significant upside potential. While QYLD may benefit from dividends and modest price increases within the index, it will underperform the Nasdaq 100 in significant bull markets. 2. Exposure to options decay. Time decay erodes the value of options as they approach expiration. Even if the underlying index doesn't rise, QYLD can experience price declines due to this factor. 3. Tax implications. The income generated from option premiums is taxed as ordinary income, potentially pushing some investors into higher tax brackets. Suitability for different investors. QYLD is not a one-size-fits-all solution. Its suitability depends on individual investor goals and risk tolerance. Income-oriented investors. For retirees or others seeking consistent income, QYLD's high dividend yield can be attractive. However, they need to understand the limited capital appreciation potential. Conservative investors. QYLD's lower volatility compared to the broader market may appeal to risk-averse investors seeking income within a defensive portfolio allocation. Short-term traders. QYLD is not suitable for active traders due to its exposure to options decay and limited upside potential. Alternative investment options. Investors considering QYLD should also explore alternative income-generating options. 1. Dividend-paying stocks. Investing in high-quality dividend-paying stocks directly offers greater control over portfolio composition and potentially higher total returns over the long term. 2. Dividend-focused ETFs. Broader dividend-focused ETFs provide diversification and exposure to companies with strong dividend track records. 3. Fixed income investments. Bonds and other fixed income instruments offer lower, but more predictable income streams, albeit with lower yields than QYLD. Conclusion. QYLD presents a unique covered call strategy that prioritizes income generation over capital appreciation. Its high dividend yield and moderate volatility can attract income-oriented investors and conservative individuals seeking stability. However, it's crucial to understand its limitations, including capped upside potential, exposure to options decay, and potential tax implications. Carefully considering individual investment goals, risk tolerance, and alternative options is essential before incorporating QYLD into a portfolio.